Alright, this is Chris from MarketSwingTrader.com. This educational video is about debit spreads. This is only used for educational purpose and is not an endorsement to purchase any stock option presented in this educational video. Please consult a licensed financial advisor before investing real money. Alrighty, now debit spreads are really good because it takes very little capital to put them on. But you absolutely have to be bullish on the trade. Right now we're looking at 3M, and let's say we think that 3M is going to make a move for about a couple dollars in about the next few days or a week. So what we can do is, on a debit spread, you're going to be buying a vertical and not selling a vertical. On the credit spreads, you sell the verticals because you're collecting theta. Now a debit spread is theta is going to be working against you. So you have to be bullish on the trade in order to profit. So let's say we think that 3M is going to move up. So we can go over here on the call side and buy a vertical. And buying a vertical is, as you can see, it's a debit of $73. Buying a vertical is the buying and selling of an option simultaneously for the same month but at different strike prices. As you can see, we're doing it for July. We've got 33 days to expiration. We're buying the 92.5 and we are selling the 95. So let's look at the risk profile, and as you can see here, the maximum loss that we can take per contract is $73, and the max profit at expiration is $177. So let's say, and at the July expiration, let's say we're right at around $95, we would capture the maximum profit, which is around $177, which is good. However, you have to realize that theta is working against you. So you're paying out this theta, so you have to be right in your direction and your timing. So let's say by the end of the month, stock really doesn't move, you could be losing money, as you can see here. Or if it moves down, you're going to be losing money. So you have to be right in your timing and your direction. So, but the good thing about the debit spreads is, if you're going to swing trade a stock, and the stock is like $90, you want to buy 100 shares, okay, you're going to have to put up $9,000. But with this, you only per contract, you're fronting up $73, and your delta is, let's say, $18. So for every dollar move, as you can see, we're going to be profiting, okay? But as you can see, with the data we're paying out, each day, let's say by the Friday, we think the stock can move up to, let's say, $92. Well, we would per contract we would make $20 minus commissions. Now that is a pretty good risk reward per contract, because you only have to front up $73 to put on this trade. Now at expiration, let's say we're at $95 or up, and let's say we're going to go over to the July, and let's say we're like a day before expiration. As you can see, we only had to front up $73, and P&L that we would have would be $131. This is a great way to profit and have tremendous risk reward if you are bullish on the stock. But you need to understand that time is working against you, okay? So, and if we reset these parameters, this is your max loss, $73, it only costs you $73 to put up the trade. Now this vertical red line, this one right here, this small little vertical red line, is at expiration. So if we go over here to expiration in July, as you can see right here, that is your expiration. Okay, that is your break-even point. So in order to profit, the stock needs to move up. Now sometimes when I'm doing these type of trades and I am bullish on the stock, I'll throw in a couple contracts. If it moves up, that's great. I'll take some off, and then I'll let it ride to see if it can keep moving up, and then I try to capture as much profit as I can. So this is just a debit spread. It is a way to swing trade a stock and not have to front up a lot of money up front. But you do need to understand that time is working against you, unlike the credit spreads where you are collecting theta. So even if the stock sits there and does nothing, or if it moves down a little bit, you can still profit at expiration. This one, the stock needs to move pretty quickly. And also it really depends on where you're purchasing, where you're putting on the trade. We put it on at 92.5, but let's say we want to buy a vertical, and the other one we would be risking $73. So if we go to risk profile here, this one as you can see, we're only risking $30, and the max profit is $220. However, you need to understand that your delta is only $10.65. So let's say we move up to $92, you'd be making 15 bucks per contract minus commissions. So the farther out you go on your strikes, the less you're risking, but also the less your profit. So that's just some things you need to play around with, and also you need to play around on the expirations, like on the 33. Let's say we did it, let's say we went to October. We think October, and let's say we know within October it's going to be trading above 95. So we buy a vertical. Okay, we're risking $78. The delta is around 866. So we are buying the 95 and selling the 97.5. And this is for October expiration. I mean, the theta we're paying now is only 18 cents. So if you think by let's say the end of July it can move up to $95, then you'll be making $35 profit. So that's just some of the things you need to play with and see how much you want to risk and how much you want to use to put on these trades. I usually use them for like 30-60 days. I don't go out as far out as October 131 days. I usually go about 30 to 60 days. Also, you need to be careful when you're doing them pretty quickly, like this one. When you're buying a vertical, and I mean that one, it expires in 5 days. It's really, I mean, it's not even worth putting on the trade. So, and also the farther you go out, the less money you're going to have to front up, but also the less profit. So I usually try to keep it around 30 to 60 days on the expiration. And that is the debit spread. 3M, we think we're going to be bullish on it, so we want to buy a vertical. Go to the risk profile, reset the parameters, go back to the risk profile, and we're only risking $73 per dollar move. It's about 18 delta, which is good. Theta we're paying out, and we are bullish on the stock, and then let's say it runs up to 92.5, we'd be making around $33. And if you want to put up more contracts, let's say you want to do 5 contracts, well, you're risking $365. If it moves up to 92.5, you'd be making $169. That's pretty good risk reward. So that is just another way to use options as far as swing trading stocks. Thank you.